right, welcome back to Financial Clarity for Doctors. I'm Corey Janoff, joined as always by Rachelle Vanderzanden.
Hello.
And we want to talk a little bit about investing, because why not? It's a finance podcast. But I was listening recently to Morgan Housel's podcast, one of my favorite finance authors and now podcasters, as well as a fellow USC alumni. Go Trojans. But he referenced a famous scene in the movie Lawrence of Arabia, which I actually haven't seen that movie. Rachelle has.
I have a very long time ago.
Supposedly it's a long one, but anyways, many of you have probably at least heard of it, if not seen it. But anyways, there's a scene where they're in some tent and chatting, and Lawrence lights a match and then puts out the match by pinching the flame with his thumb and index finger. And then one of the other guys in the tent looks at it and he wants to try it. So he lights a match and he does the same thing and pinches the flame to, put it out with his index finger and thumb. And he immediately shakes his hand and exclaims, "Ooh, that damn well hurts." And Lawrence, I'm paraphrasing here, but he replies whimsically, "Certainly it hurts. The trick is not minding that it hurts." And the whole parallel or analogy here is sometimes investing can hurt, right, Rachelle?
Lots of things can hurt. And, sometimes we just have to get used to it and toughen up a little bit, which I guess is the point. But I think a lot of times with our clients, we don't try to sugarcoat things. The goal is not to tell people that everything is going to be rosy and amazing forever, because it's not. And the one and only guarantee that we can make people is that their investment accounts will go down in value at some point. Like, they're not going to stay on an upward and to the right trend forever. There will be bumps in the road. It's kind of like, if you're playing pro football, the odds are about 100% that you're going to get injured at some point in time. It may not be this year, it might not be this decade, but if you play long enough, it'll happen. So with lots of different things, like, there is inevitably going to be a point where something will hurt, either literally or figuratively. And we have to kind of get ourselves used to the idea so that when it happens, we don't make any knee-jerk decisions and change things in ways that don't make sense. So seeing your accounts go down in value, that hurts. Like, mentally, psychologically, maybe even emotionally. For some people, it doesn't feel good, that's for sure. And the trick is just to not mind so very, very much, and maybe ignore it a little bit. So anyway, you just have to kind of be okay with that and accept the fact that your investments will go down in value from time to time. That's kind of the price that you pay to play the game. Same as football, I guess. Like, at some point, if you're playing football long enough, it's going to hurt. And, really, this is the best way that we have humans, as humans so far, have kind of figured out to grow wealth. It's kind of the price you pay to play that game, which is an important one nowadays.
Yeah. If you're a pro football player, you accept that you're going to have some injuries in exchange for potentially millions of dollars. And if you're an investor, you got to accept that you're going to see your accounts go down from time to time in exchange for potentially growing it into millions of dollars. So, the stock market, it's been one of the greatest wealth growing machines that humans have ever created. I can't think of any other tool or vehicle that has helped grow people's wealth, and not, just the elite, but the masses. I think something like 2/3 of Americans now own stocks. Didn't always wasn't always that much, but it's very accessible now. You can open an account in a matter of minutes with as little as a few dollars and start investing. So the barriers to entry have more or less been eliminated. Anyone has access to it and can participate in the historical growth potential that the stock market has delivered. I say potential because who knows what will happen in the future. Maybe we've peaked as a human society and it's just downhill from here. But I'd like to think not. And we still got some room to run. But some stats for you here, because I like stats and data. But S&P 500 since 1960. Why 1960? Just because I felt like that was far back enough. Figured, 75 years? Is that right? No, 65 years of time horizon. Yeah, it was a long enough period.
That's a pretty long time.
Yeah, pretty long look back. Also, like, I didn't want to go pre-World War II. Taking out the post-war boom as well. So 1960, just for fun. So the S&P 500, the beginning of 1960, the data sources are a little conflicting. I found some different numbers, but it was around 58 or 59, not dollars, but points, I think is how it's measured. Um, June 23rd, which is as of yesterday, we're recording this on the
Hmm.
24th. The S&P closed at,
2026. Yeah.
yeah, 2026, 2026.
Yep.
Uh, yeah, AD. But the S&P 500 closed at 7,365. So it went from 58 to 7,300. That's pretty good. Now most people weren't
Hmm.
investing for the last 66 years, but for some quick math, that's a 127x growth rate, meaning if you invested $1,000 in the beginning of 1960, it'd be worth $127,000 today. And that's just the nominal price increase. That doesn't include dividend reinvestments. If you were to reinvest your dividends, it'd be worth over $700,000.
Hmm.
Now, keep in mind, you can't invest directly in an index. There are index funds, but back in 1960, those didn't exist. So, this is kind of definitely a hypothetical example that isn't actual or feasible. But I think the earliest S&P 500 index fund was in the late 70s, I want to say. Don't quote me on that, but Vanguard founded it. And nowadays you can basically invest and replicate the index pretty darn precisely at almost no cost. I mean, there's some minuscule costs associated with these index funds that is going to result in some minor tracking error, but overall,
Yep.
um,
Computers help, that's for sure.
yeah, you can get it pretty darn close. But
Hmm.
despite that growth, would have had to stomach some bumpy rides, bumpy roads, speed bumps,
Rides,
potholes,
whatever.
washed out roads, mudslides along the way.
Yeah.
Right,
I
Rachelle?
think, yeah, since 1928, so we're looking a little farther back here, but the S&P 500 has experienced lots of declines. So when we're looking at just 10% plus declines, that's happened 56 times, which is a ton. If we're looking at 20% or more, that's happened 22 times. So still quite a few. 30% plus has been 13 times, 40% plus has been 7 times since 1928, which is huge. Like that feels devastating when that
And I think
happens.
like half of those were in 1929 and the 1930s. So
Hmm.
it hasn't happened very often in modern
Right.
times.
So definitely some volatility early on in the stock market with the Great Depression and everything like that. From 1968 to 1982, the market was basically flat. So with inflation, you would have lost quite a bit in real dollars because inflation was also high during that time. So it's not like every period of time is going to necessarily be great in the stock market, but if you're invested for a long enough period of time, it's always gone up in the past. So since 1990, we've seen at least one 5% pullback in the S&P 500 in every year except three. So that's good to know. Like even in years when the market is up, like we're still usually going to see some intra-year declines, so some declines throughout the year that will make it feel like the road is bumpy, even if overall that year the stock market did fairly well. So you've got to be willing to kind of experience and ignore that pain a little bit. Just the last several years, despite the market having really, really excellent years, we've seen 10+% pullbacks in the spring of 2024, the spring of 2025, and a close to 10% pullback in early this year in 2026. So every single one of those years, we ended up positive, like double digit positive, right, Corey? Yeah. So it's even in those years where things go really well, there may be a point where you're like, ooh, do I really want to be in this? And Corey and I get emails from clients sporadically when those things happen where they're very much like, hey, like we're seeing this, what feels like a very big correction. Should we be doing something different? And chances are the answer is no. Like, obviously, every situation may have a different answer, but realistically, even when the market is going to end up in a year, it may feel like it's not going to. You may have a moment in time where it feels like this is not good. We need to like bail on this situation. And you just got to trick yourself into being like, this doesn't hurt. That's fine.
Or you acknowledge that it hurts.
Yeah.
Just the trick is not minding that it hurts.
Yes.
Know that, hey, this is gonna be a
There
little
we go.
painful. Um, but that's part of
Weather
the,
the storm.
yeah, part of the game. Like Yeah, the market, even when it goes up, it goes down. So you mentioned the 5% pullbacks, like almost guaranteed that you're going to see at least a 5% drop throughout any given year. 10%, it's like every other year, maybe even a little more frequently than that. So that's
Hmm.
very normal to see the market go down, even when it finishes positive. Like the S&P, I think it's averaged over that time span, about a 10% annualized return, give or take, plus or minus, depending on your data source and time frame. Um, but the average downturn throughout a year is also double digits. I think it's like 13%,
Hmm.
based on JP Morgan's research. Like even in when you're finishing the year positive, you will see a decline throughout that year at some point in time. And when it happens, it hurts. It's
Hmm.
not fun to look at. So I guess, maybe don't look at it and then you won't even notice. But
I think the
um,
other thing is that when you see these big declines, sometimes it feels like, oh, we should have seen that coming. It's so obvious, like why this happened, blah, 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 blah. And like we should have been making some different choices, but it's not because those same things could happen in a different time frame and the market doesn't go down. Like it's very unpredictable in a lot of ways. Like in some ways, you can kind of see the writing on the wall a little bit, but it's so hard to interpret how that writing on the wall is actually going to just extrapolate down like through the performance itself. It doesn't always line up the way that, or rarely, I guess, lines up exactly the way that you would expect it to. So don't try to think that you can guess ahead of time.
yeah, no one knows. Some
Nope.
people can guess right, but no one really knows. I mean, like
Sometimes,
the
yeah.
last Yeah, sometimes you get lucky. But I mean, the last several months, or couple months, like when did we invade Iran or bomb them or whatever? Like, and all the prognosticators were like, oil's going to 150, $200 a barrel. If the Strait of Hormuz doesn't open up in the next week, we're all screwed. And energy prices are going to $10 a gallon gas. Again, as of late June, oil's basically round tripped. Yeah, it went up and now it's back down. What is it like? I think $80 a barrel today.
Hmm.
Price of oil today, $70 a barrel for crude oil futures. What's Brent crude? What's the difference between crude and Brent crude?
No idea.
Like, why is it called Brent? So Brent is $73. So I wonder if it's
Lower
named after a guy
quality if
named
it's less
Brent.
expensive.
I have no idea. Um,
Yeah.
we're not oil traders. But
Nope.
anyways, so yeah, oil back where it was pre invasion. So this whole Strait of Hormuz, like, didn't really affect, I mean, sure, temporarily affected things. And hey, we're not out of the woods yet. Like, it
Hmm.
could get worse. It could go back up again. Um, but all the people who are saying, hey, this is going to totally, screw up the supply chain, screw up oil prices, blah, blah, blah. You just don't know how the market will react, new opportunities. That's the one thing about a for all intents and purposes, free market is where there's opportunities and voids, entrepreneurs go to fill them. Where there's demand, supply will meet the demand somewhere. So if there's a demand for something, like, and it's not like you can just snap your fingers and make things
Hmm.
happen. I mean, you look at semiconductors, like the semiconductor index is up like 200% for the last year. Um, but it's not like you can just bring more semiconductors to the market. Like it's a multi-year long process to start manufacturing those.
Hmm.
That being said, there's definitely companies out there trying. Same with this whole AI data center thing. Like, hey, we're gonna run out of power. We need more data centers. We need more energy efficient ones. Like I just saw there was a startup out of Portland actually that created these like floating data centers that will stick out in the ocean and the current and waves will power them using hydropower. So they're just going to be these self-sufficient electricity, self-powered data centers and hang out in the ocean and probably beam our AI queries up to satellites and back. Don't ask me how it works, but yeah, cool stuff. Like people find ways to meet demands when
Innovation.
yeah.
Hmm.
So,
Yep.
anyways, digressing.
It doesn't always work perfectly, but there's lots of different levers and things that people can pull. And again, like we could also think the stock market's going to do great this year. It's going to be amazing. And maybe that's the year where it doesn't do so well. But I mean, the goal is to not try to guess because honestly, like we're going to guess incorrectly most of the time. There are lots of great quotes about investing in stocks that have to do with this kind of pain tolerance and everything. But I think there's a few of them we're just going to go back and forth and say them out loud because they're fun. One of them is far more money has been lost by investors trying to anticipate corrections than lost in the corrections themselves. And that was Peter Lynch. He was a Fidelity fund manager. But basically, the idea is like, we're trying to guess ahead of time when the stock market's going to go down. So we pull our money out. And then, like, when it goes up, we've lost on all that upward growth potential. So, yeah, lots of things like that happen.
Yeah, I think it's when people try to time the market, um, it's so difficult because you got to make multiple correct predictions and then have a plan to get back in. Like, all right, great, congratulations, you got out at the top and then it came down. How are you going to get back in? Like you look at people that got out during the financial crisis, 08, 09, 2010, sold out of their stuff. Um, and many of them didn't get back in
Is
because they
weighted
were
on the
just waiting
sidelines.
for better news. It's like, hey, the economy's still in a rut. Like, jobs aren't happening. Uh, I don't know if I feel comfortable. I feel like we're going to go back down again. And, I remember, when I started this career, like the entire 2010s, like all the, financial outlets, investment banks, fund companies, et cetera, all their reports are like, hey, headwinds in the labor market, the pessimism on the consumer, lack of money, lack of credit. It's all tight because banks stopped issuing credit to people after they all defaulted on their mortgages. And we expect it to be, really low growth, maybe in the 2 to 4% range over the next decade for stocks. And what stocks do? Up double digits. Like it's, and not just not like 11, 12, like 15, 20% double digits. So,
Yep.
um, you can have all the information in the world. You just really don't know how it's all gonna pan out. But yeah, Peter Lynch, when I was looking at this, we could have had like 100 quotes from Peter Lynch, but I felt like it'd be kind of weird to just have Peter Lynch quotes in here. So we cherry
Hmm.
picked a few from some other people too. But um, here's another good one. If you have trouble imagining a 20% loss in the stock market, you shouldn't be in stocks. That's by
That's
John
just common
Bogle.
sense.
Yeah, founder of Vanguard. Stocks go down like 20% every handful of years. That's
It
very
happens.
normal. Happened last year, happened in 2022. Um, it's part of the game.
Hmm. Yep. Another one is if you don't like to lose money and it affects your judgment, don't buy things that can go down a great deal. And that was Walter Schloss. He was a Schloss, I can't say that, famed investor from Benjamin Graham. Wait,
He was a
I don't,
disciple of Benjamin Graham. So kind of
that's
like Warren
not,
Buffett.
yeah,
So
yeah,
learned from his tutelage.
yeah.
But
I think that makes sense. Like this next one. Also, Peter Bernstein. He said the most important lesson an investor can learn is to be dispassionate when confronted by unexpected and unfavorable outcomes. Maybe dispassionate is the same about, like, not caring when your fingers get burnt.
don't mind that it hurts.
Don't mind
Yeah,
that
and
it
back
hurts.
to the Walter Schloss one, it's like, oh, if you don't like losing money, don't buy things that can go down, which it's like, all right, so don't buy stocks. Well, we also need things that go up if we want to outpace
Mm-hmm.
inflation. That being said, we don't have to own a portfolio of 100% stocks. Like if you can't handle the bigger declines, maybe we find a more balanced portfolio of like 50-50 stocks bonds, 70-30 stocks bonds, just something to take the edge off a little bit so
Mm-hmm.
that instead of a 20 or 30% decline, it's a, 10 or 15% decline when the portfolio goes down. Um, so there are ways to work around that and try and mitigate some of the downturns, but it's going to be darn near impossible to completely eliminate the downturns unless you just
Mm-hmm.
stick your money in a savings account and then you're losing out to inflation over time, most likely.
Yeah. Yeah. I think
Um,
that's also something to reevaluate over time when you settle on these allocations. Like I feel like 60/40 is good for me. So 60% stocks and 40% bonds. Maybe right now it makes sense for you, but maybe it doesn't a few years down the road. I have one client who I was just talking to, and she was kind of like on the fence about buying a house and kind of wanted to invest money, but didn't because she wanted it to be available if she like bought a house. And so we just decided to use a more conservative investment strategy and maybe just go 60/40 so she could invest, but also not be too worried about her money losing a ton of value. Like you just kind of mitigate that loss potential. But now she's like not really planning to buy a house anymore. So it's time to have that conversation again. Like, okay, at this point, if we're investing this money for retirement, we can reconsider how it's invested and maybe make some adjustments. So don't set it and forget it. To a certain extent, you got to reevaluate your goals and make sure that everything that you're doing still makes sense.
yeah. And the last
Yeah.
one, everyone's probably heard of Warren Buffett. The stock market is a device to transfer money from the impatient to the patient. So if you just sit tight, ride it out, keep buying, you know,
hmm
eventually you should end up with a big pile of money. No
Depending on how much
guarantees.
you invested to begin with, if you put
Yep.
$100 in, it's not going to be very much.
Should be worth more than 100 though, 30,
It'll
40,
be worth
50
more than a
years
100.
from now.
Yes.
So let's see what to do. Like, what are some action or inaction items, steps, considerations? Because, we've been spoiled the last several years, really the last 16 years. Since 2009, the stock market has basically gone straight up. Yeah, we've had some blips along the way. Yeah, we've seen a few declines here and there. 2022 was a tough year. We've
hmm
had some periods during years where it's gone down. We've had a couple other flat or slightly down years, but we basically haven't had a recession in 16 years. Like, I'm not counting COVID because, I mean, yes, technically it was a recession, but it's like the shortest recession ever. And we've come
Yep.
out of that super strong. Um, and 2022, again, not really a recession. Like, yeah, the stock market was down, but that was about it.
hmm
Um, so, and Rachelle and I aren't predicting any impending doom here. We're just like, hey, stock market's up. People might be getting overly confident. Let's let's remind ourselves that, hey, it doesn't always go straight up. Like, it can
hmm
go down. And, as economist John Kenneth Galbraith once said, the only function of economic forecasting is to make astrology look respectable. So, no offense to all those investment prognosticators and economists out there,
Or
but
astrologists.
yeah, you got better odds, trying to predict what your investment account's going to do by looking at the stars and reading horoscopes. Um, again, it's darn near impossible to predict what the, you know, collective minds of humanity, how they will feel and react, and where their purchases and dollars will go, you know, week to week, month to month, year to year. Um, you know, it-
hmm
it's it's a tall task, so would recommend not even trying, but just um just
Yep.
just know that this is part of the game. So we
Yep.
can go ahead.
No, I was just going to say, I mean, like at some point, the stock market will go down and your investment portfolio can and will go down. But I think the other thing is to keep in mind that sometimes that'll happen for a multi-year period. It's not, I think that one of the big changes or one of the big differences with the last 16 years is that when we have seen these declines, like we've recovered very, very quickly, which is not always the norm. So that'll be interesting, especially to see our young investors kind of get used to like some of these other blips that can and will happen most likely between now and when they retire, where there's a correction and it doesn't recover immediately. Like that's going to be a little harder to stomach. So we're going to have to work our way through those ones for sure.
Yeah, like tariff tantrums spring of 2024. Like, if you just didn't pay attention for a couple months or didn't look at your accounts for a couple months, you wouldn't have known that they were down 20% basically.
Yeah.
Same with last spring. What was last
Or
spring's
even
news?
COVID. Like COVID was a
Yeah.
big decline, but
COVID, if you
like by
didn't
the
look at
end of the
your
year,
investment accounts for a few months, like, you're like, huh, stock market's doing all right. Who would have
fine.
thought? Um, yeah, like, it's recovered so quickly. Of course, there's no guarantee. that it will ever go back up again, but the weighty evidence of history would suggest a very strong possibility that it'll eventually rise after it falls. And even
Mhm.
though it's going to hurt when it's down, and if it's down for multiple years, like we have seen throughout history, like there have been multi-year periods where it's
Mhm.
down and doesn't come back up, um, it's going to hurt. But the trick is not minding that it hurts and know that that's part of the game. And if you have money you need in the near future, like the home purchase example, like it shouldn't be in something that can go down if you need it soon. But we're talking
Mhm.
long-term money here. Like, for Rochelle and I, we've got hopefully a 60-year time horizon on money that we're investing. Like we need it to last the rest of our lives. So it's like we accept that there will be some downturns along the way, but for a multi-decade time horizon, that's okay. So,
Mhm.
what to do?
Be diversified first and foremost. So, we may have a chunk of money in the S&P 500. It's up 21%
Trailing 12 months.
over the last 12 months, which is pretty darn good. But, there's other markets that we're investing in as well. Like the Russell 2000 is up 40%. That's small and mid-sized companies. The NASDAQ is up 28%. So more like industrials and things like that. Gold and silver is up 53%. The MSCI EFA, so like the international index, is up 22%. Emerging markets is up 44%. So even when the stock market, and a lot of times we use the S&P 500 as a stand-in for like the stock market, that's not the entire stock market. But even when it's up, there are other things that could potentially be up more. When it's down, there are other things that could be down less or maybe even up a little bit. So being diversified is very, very helpful. And if you can't stomach big declines, don't be invested 100% in stocks. Like most of the time, those move together. So maybe we want a little bit in bonds. Maybe we want a little bit in like a gold ETF or something like that. You find a portfolio allocation that you can stomach and stick with it. So is this an allocation that has like moves or potential moves that I would be okay with and I could like handle the downside so I'm not inclined to sell when things are down because that's what we don't want to do. We don't want to get it stuck in a position where it was really too much for our risk tolerance and now we're making some poor emotional decisions.
Yeah, and I mean the US, we can drag the world up and down with us. The S&P
Hmm.
5 or the US stock market is like over 60% of the global stock market. So, we definitely are the 1,000-pound
Driving
gorilla
force
out
kind
there.
of thing. Yeah.
But I mean, like they don't always move in tandem. Like early 2000s, US stocks kind of sucked, but international and emerging markets did all right. So
Hmm.
that's why we want to be diversified. It often, you know, there's it, 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 it moves in decades sometimes.
Hmm.
We might have like we've said, a good run here in US stocks, but last several years, and I don't know if this is a foretelling of the next handful of years or so, but international stocks have outpaced US stocks the last several years. So
Hmm.
maybe you aren't aware of that or didn't know that. It doesn't make the news headlines really, because that's kind
Yeah.
of boring stuff to talk about. But if you're paying attention to the markets, it's like, huh, all right, way to go,
Hmm.
our friends overseas. Like you guys are doing quite well uh, with your investments. So
Hmm.
that's why we want to be diversified. You never know what area is going to do well from year to year or decade to decade. Um, another tip: don't look. Like, in a perfect world, investors would invest their money and not be able to see it for 30 years. Obviously, we're talking retirement money here. And historically, the odds are 100% that it goes up a lot in that
Which we
scenario.
can't guarantee again, but
Nope. That's what I said historically. Moving
historically.
forward, who knows? But there's never been a 30-year stretch where US stocks, at least, have not appreciated considerably. Um, there might be a decade where they struggle, but it's, yeah, if you don't look at it, if you don't know the price, like your house, it's only worth what someone's willing to pay for it. And sure, Zillow, gives you a price estimate, but I don't think everyone's looking at the value of their house daily on Zillow. And even if they were like, oh man, our house is down 6% this month. Like, okay, are you moving?
It doesn't matter unless you're
Like,
going to sell it.
yeah, like you're probably not listing it. It's like, oh shoot, do we need to sell our house to prevent it from going down even more? No, you're just like, huh, well, that's
It
all.
is what it is.
Like,
Yeah.
it's like that scene in, what is it, Dumb and Dumber? Huh? Big gulps, huh? Oh, see you later. But yeah, like there's like you're not going to take any action, but because we can see the price every second of every day of our investment portfolio, if we look, it can drive us nuts.
And you can sell it so much more easily. You know, with a house, like
For
it
sure.
takes so much work to sell. But with stocks and mutual funds and ETFs, it's like push a button, you
Yeah, you can
know.
be sitting on the couch in your pajamas and just from your phone make some trades. You can't just sell your
Don't
house
do
from
it.
your phone. You
Mm-mm.
might be able to. Wouldn't recommend it. But there's other things like we've talked about structured notes. You could buy some buffered notes that have downside protection, so you still participate in the upside, but the downside is limited or reduced. You could throw some money into an annuity, where it's I don't like saying
You
the
have
word
guaranteed income,
guaranteed, but
basically.
it's like,
Hmm.
hey, here's the guaranteed amount that you're going to have. You could turn it into a guaranteed lifetime income stream. As long as the
Yep.
annuity company stays in business, you'll get that money. Um, Odds are it'll probably grow more, leaving it in the stock market over time. But if your objective is sleeping well at night and you don't need it to grow more, having that fixed income stream might be appealing. So,
Hmm. Yep.
a
I have
lot
some
of,
clients who are definitely like a little nervous about the stock market and, they have Social Security income and it's like you have that. Like that is there. That's not going to go anywhere for you probably. And then, they have an annuity that they haven't like annuitized yet. And it like we go back and forth a lot on like, do you want to do that or do we just want to move it? Because realistically, like you're living kind of on your Social Security income. But I think you'd be a lot more comfortable if you had additional guaranteed income, even though you have more than you need right now. Like sometimes it's just about like what keeps you awake at night and what can we do to mitigate that? Because realistically, for a lot of folks, they've saved well, they've set themselves up well for retirement, and it's just a way to kind of manage that and give you peace of mind to a certain extent.
yeah, no, I definitely, as I've progress further through my career, reverse solving around peace of mind for
Mm-hmm.
clients can be beneficial. There's like the optimal solution, and then there's the reasonable solution. And if you're more likely to stick with the reasonable solution than the optimal one, well, let's go with something you can ride out and follow through on than something you might bail on if there's headwinds. So,
Yep.
um, yeah,
It's
as always,
interesting.
it depends on circumstances, objectives, goals, what you're hoping to accomplish with the money.
Yeah. Yep. I think half of our job ends up being math and half of it ends up being kind of behavioral management.
Therapist.
Like, yeah, oh yeah, a little marital counseling once in a while. Not we are not licensed marital counselors, just so everyone knows.
Yeah.
Oh.
Well, thanks
Yep.
for listening. We'll see you guys next time.